But for
Mm-hmm.
working capital, I would just say, look, I need to buy a company, and our metaphor is usually a car that's got some gas in it.
Mm-hmm.
So I need to buy with enough gas to get me to the next gas station.
Right.
So that's where I'm going to use as my peg. I need to get 30 miles. This thing gets 30 miles to the gallon. Okay, I need to buy a gallon of gas. That translates to, you know, $2.79 of inventory that I've got to have on hand that I could sell tomorrow, convert to cash, and then I can keep paying my people and order more inventory with that cash so that we don't have an interruption of operations. And I, the buyer, don't have to come out of pocket to put more money into the business just to hold
Mm-hmm.
serve.
Hmm.
If I want to
Yeah.
Yeah.
grow, sure, you got to put more money in. But if I got to
Right.
put more money in just to stay steady, that's actually an increase to the purchase price. And
Right.
I'm
Hmm.
going to tell you, the buyer
Right.
later is going to call that unfair. And in his shoes, I get it.
Yeah.
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 Then, we kind of got one time.
Welcome to the How to Buy or Sell a Business Successfully podcast. The concepts discussed in this podcast are for informational purposes only. No attorney-client relationship is intended or formed by this podcast. No legal advice is intended in the substance of this podcast. Feel free to check out our website, www.goforemanlaw.com. Enjoy the show and welcome your hosts, Jake Wayman and Sam Foreman.
Well, welcome back, everybody, to the How to Buy and Sell a Business Successfully podcast. My name is Jake Wayman, and my wife and I are the proud owners of Orange Theory Fitness here in Wichita. And I also have a fractional business development firm called Wayman Consulting, work with a lot of companies, helping them grow their top line revenue. And the most fun thing that's going on in my life right now with my kids is it's the two P's, not like what you're thinking, but it's pizza and pancakes. Like my son and my daughter are they are like these pizza and pancake connoisseurs, like microwave pizza connoisseurs.
Nice.
And so we've gone through lots of iterations of microwavable pizza and also with like pancakes. I've found that Kodiak, the protein pancakes, are like what they love the most. And so
It's a good pancake to love.
yeah, so it's a lot of fun, but like literally I know what they're gonna eat for breakfast and I know what they want for dinner, and that's it, the two P's.
That's
What's the
awesome.
winning
So
pizza?
do what?
What's the winning pizza?
So right now it's actually Walmart's Great Value brand, and they
Get
have
out.
it's like a mixture of
Nice.
like sausage and pepperoni on it, and now like that's all my son wants. Like I've gotten Costco brand, hates that. The Kroger brand hates that, and then we just started doing Walmart Plus, which is a changer inside our world with having it delivered to us. But like it's that one, that's like the best one. So, anyways, that's good. I've had a couple pieces of it too. So.
No,
Anyways, but
that's
I'm
awesome.
joined with my awesome co-host that we've been doing this for, I think, going on 2+ years now. But
Yeah.
Sam Foreman.
Yeah, well, I'm Sam Foreman. I'm the founder of Foreman Law. We focus on mergers and acquisitions and ownership transitions. And one of the best things in my life right now is that I love playing jokes on my wife. Um, Usually I have to make sure I'm a safe enough distance away because her fight or flight response is definitely fight. Um, and so
So if you come with the black eye,
this,
that's the reason why.
yeah, I fall a lot. One of our previous guests here, Rick Ralston, who wrote a great book called The Forecast, which listeners, if you haven't read that yet, please get yourself a copy of it and buy a copy for a friend. But he and I were having coffee the other day, and he said something. He was trying to text, and he said, I just wish I had smaller thumbs." And so, me being an immature person, what I did was I went onto Amazon and I purchased a set of those little hand puppets. Jacob's gonna grab one, grab one off camera here. and so, and I've been waiting to see Rick to give him these. And so, yeah, if you're listening to this, I'm sorry you don't get to enjoy this visual treat as Jacob's going to give you 4 thumbs up here. But I got him those. And I'm like opening the package of those, and my wife being like, "What the hell is this?"
Well, hence
It was just so delightful.
Rick left them after he left the podcast, so I
Yeah,
guess he didn't appreciate the
he
two
liked the
thumbs
gift
up.
so much. Is like, I'm not taking this with me. But my favorite moment is my wife's on her feet a lot because she is the primary caregiver for our two very mobile, very active children, and so I try to do my part by giving her a foot rub every now and then. Is the other night I was giving her a foot rub and I used one of those little hands. It's just like, what is going on? What is going on?
Is it,
And then I'm like holding up the little finger hand puppet thing. It's just
that's
like,
just
oh my God,
there's
it's
so many
so great.
visualizations that I just want to get out of my mind
I
right
know.
now. And
So
now we're
maybe we'll have to edit that out, or we'll
and
leave
our
it in.
guest
But
is our guest
oh
is
yeah, yeah, Ben's here. Do we just need to restart the episode? Now let's keep going. Let's keep going. I deserve whatever negative treatment happens to me in life for what I've just done to our listeners and to Jacob, who's now unfriending me in real life and on LinkedIn. We're very grateful today to be joined by a really good friend of mine, Ben Olsen. Ben works with a lot of business owners through his work in with Tarsus. Tarsus provides a lot of financial services, accounting services to their clients. Ben is an expert at many financial things, has a lot of experience in the M&A world, and really excited to have him here today. He's also a father of five children, which means that he has mastered the art of multiplying the amount of time that you can, excuse me, multiplying the impact that you can get out of a limited amount of time. So, Ben, why don't you tell us and our listeners more about yourself and the work that you do?
Yeah, thanks. Well, happy to be on here, and sorry for interrupting the intro earlier. But Jacob, for obvious reasons, if there's such a thing as microwave pizza or any other hack to feed a lot of hungry children, I need to know about it like
yeah,
right
yeah.
now. So yeah, thanks, Sam. Great to join you and Jacob. I'm excited to have this conversation. Yeah, I'm born and raised in Kansas City. I am to date still the reigning champion of worst nepotism hire ever. And I'm in the industry that I'm in through a series of accidents and learning on the fly. I've spent about 15 years in a couple small business brokerage firms, and then I've been with Tarsus for the last 3.5 years. I've had the privilege to be a business owner. I've been on both sides of the table for the conversation on how we're not going to make payroll this week. And I've had the chance to sit with a lot of business owners in really vulnerable moments, whether they are going through what we lovingly refer to as corporate puberty, and they're growing through a step change in the nature of their business and often their own identity. And in some cases,
Mm,
that will mean a real personal period of growth when they sell a company or buy one.
mhm.
And I've been at the table for over 100 of those, probably pushing 200 at this point
Wow.
Mm.
throughout again my coming up on 20-year career. So yeah, I've got a lot of battle scars from being in those foxholes, and it's still really enjoyable work to support people in creating and sustaining jobs and vocations.
No, that's great, Ben. What's one of your favorite things about working with business owners through the sale or acquisition process?
Well, I think that I'm just a curious person to begin with, and there are so many companies that are hiding in plain sight that you have no idea, or I have no idea, as I just kind of drive around with my mouth hanging open, thinking about, okay, it turns out that tunnel car washes, phenomenal business.
Mm,
They're incredible. Also, there's a little shop around the corner from the place where I go play old man indoor soccer in an over 40 league. And they produce some of the most technologically sophisticated flame retardant parts for commercial jets authorized by the FAA. And when the
mm.
FAA authorizes a part,
Yeah,
you
that is
drop
no
off
joke.
the paperwork by the truckload. I know for any of our
Right.
non-Wichita listeners, that would be news. So, there's a spread of the people that we get to deal with that self-select into owning and operating those businesses that are just fascinating people. And then the dynamics of every business, on the one hand, are unique, and on the other hand, are shockingly consistent.
Hmm.
No, that's terrific. Well, hey, one of the things we really wanted to dive into for our listeners is a really important topic around networking capital.
Hmm.
Ben, why don't you tell us a little bit more about what is networking capital for folks that may not be really familiar with that term and how it's traditionally defined in a in a business context in a M&A context especially.
Absolutely, yeah. Well, first and foremost, it's important to know that net working capital is three words: net, working capital.
Hmm.
So this is not a business development asset that you have. Net working capital is classically defined the delta between your current assets less current liabilities. And current asset examples, those would usually be cash, inventory, accounts receivable. Your classic current liabilities are things like your accounts payable and any short-term liabilities, including payroll, for example. Um, and why is that important and why is that so critical in mergers and acquisitions? Well, when you take your cash and the money that's owed to you but hasn't come in yet, and then you try to balance that against the amount of money that you owe other people in the next 30 days, you get a pretty good picture of the oxygen in your business, which is the cash that you need and or the access to credit to continue to run your operation. And so working capital, and particularly the net of working capital, again, how much do I owe others and how much have I got coming in the short term? That is that the knowledge of what those numbers are and the time that's associated with them, the timing, is critical. So when you get into a business and you're learning everything about it and you're wondering, well, how fast do people pay for aerospace parts? Well, it turns out Boeing is going to pay a little bit different than a different
Hmm.
manufacturer. Uh,
Right.
and maybe
Right.
there will be some other idiosyncrasies to how you get to pay your suppliers. Well, that really matters when it's time to pay your people who consistently expect to get a check every 2 weeks, maybe twice a month if you're doing it that way. And they really don't have a sense of humor if that check doesn't show up. So, understanding the importance of the timing and the amount of your access to cash is really the essence of what working capital is meant to convey.
Hmm.
Yeah, no, that's helpful. When you're looking at the from a buyer's perspective, or it could be from a seller's perspective, and you're looking at networking capital, are there particular thresholds, or is there a way to figure out particular thresholds or ranges to be able to say, okay, this business has a healthy amount of networking
Mhm.
capital, or oh my gosh, I hope they have a good line of credit ready. Um,
Yeah, yeah.
how do you go about that process of figuring out that there's enough liquidity involved with networking capital?
Yeah, it's a great question. And one of the critical questions that we would want to try to answer for anybody who is buying a business in particular,
Hmm.
nobody buys a business to leave it the same size,
Hmm.
and growth costs money. And
Right.
so having enough working capital to hold serve is one thing. Having
Hmm.
enough working capital to then grow is
Right.
another. So if you're going to hire somebody, well, that probably counts against working capital from a standpoint of I need to make sure that I can cover the next, 14 days in the pay cycle for that individual when we bring them on. Well, if they also need a truck and they also need tools, and then you're going to have to order inventory for them to put in said truck, well, that kind of counts against working capital, or maybe you capitalize that expense. Do you borrow for the truck? Do you come out of the cash that you've got because you're carrying excess? I mean, those growth investments all sort of combine, and you have to have a conversation that's probably not like a gap accounting driven conversation. It's more like
Hmm.
a can I do this or not? Where's the cash
Yeah. Yeah.
conversation, right?
Yeah.
And
Yeah.
so uh,
Yeah.
from that perspective, working capital can be kind of two things at once. It can really we can boil the conversation down to a cash forecast discussion, which is
Hmm.
just, hey, irrespective of gap, assets, liabilities, debits, and credits, I don't really care. When's that next dollar coming in and how fast after it comes in have I got to pay it back out again? That's a pretty simple discussion. You can do that on a
Hmm.
napkin, and you can do it very effectively. No apologies for that. Separately, though, if you want to get into the calculation of what a net working capital peg should be, and how do I know if I've got enough, and enough is not a number, so let's make it a number. That discussion usually requires you to track 24 months, I would say, of month by month uh, calculation of just, on the last day of the month, what was the net working capital, current assets less current liabilities, how much did it fluctuate and why? And can we get a good explanation for that? Certain businesses are highly seasonal. Black Friday for realtors means that they've ordered a ton of inventory in June and July most of the time. Working capital is going to be very low in June and July because they're turning all their cash into receivables and hoping that that inventory converts and then sells later for them. In professional services, you might see a more consistent flow, and so your net working capital variability should be minimal, one would
Hmm.
think, unless you're in a season of growth, in which case it's going to change.
Right. Right. Yeah, no, that's helpful. So, for our listeners who may not be familiar with the term yet, can you kind of walk us through what a networking capital peg is and sort of the role that it plays in an M&A deal process and structuring?
Definitely. So working capital is usually one of the things that gets left for last in the calculation because to know whether or not you've got enough, you have to understand the business pretty well.
Hmm.
And so you can try to put a working capital number that is a target figure. A peg is just a target. And we want to buy the business with what would be an appropriate amount of working capital included in it. There's a ton of arguments, and some of them are philosophical and some of them are practical around why people can value a company up to a certain point for all of its tangible and intangible assets, its blue sky, and then go over to the side and make a separate calculation for working capital and add that to the value of the company or not. Or you could just say, hey, I'm slapping a multiple of EBITDA on the whole thing. That's inclusive of working capital, and therefore the price is the price. Hey, look, at the end of the day, we're still talking about, at some
Right.
point, an absolute number that's the same thing. There's different paths to get there. So let's not get bogged down in the timing of when I announce what my working capital is and how I present that in an LOI, et cetera. The peg should really just be a recognition that one of the assets of the company that produces the EBITDA, the cash stream, seller's discretionary earnings, whatever you want to call it, there's 50 euphemisms for that. The cash that is generated by the company that I care about, which is what I'm going to use to repay debt and then generate return on my equity investment, that cash is produced by a combination of all of the assets and all of the liabilities in the company as it exists today.
Right.
So, philosophically and practically, much of the time, most of the time, why wouldn't I buy those assets and liabilities, probably excluding most, if not all, of the cash? Because why would I buy cash? I'll bring my own.
Right.
And or some of the liabilities like notes to shareholders, which are usually not in
Hmm.
current, they'd be long term, those are
Hmm.
usually excluded. But for
Hmm.
working capital, I would just say, look, I need to buy a company, and our metaphor is usually a car that's got some gas in it.
Hmm.
So I need to buy with enough gas to get me to the next gas station.
Right.
So that's where I'm going to use as my peg. I need to get 30 miles. This thing gets 30 miles to the gallon. Okay, I need to buy a gallon of gas. That translates to, you know, $2.79 of inventory that I've got to have on hand that I could sell tomorrow, convert to cash, and then I can keep paying my people and order more inventory with that cash so that we don't have an interruption of operations. And I, the buyer, don't have to come out of pocket to put more money into the business just to hold
Hmm.
serve.
Hmm.
Yeah.
If I want to
Yeah.
Yeah.
grow, sure, you got to put more money in. But if I got to
Right.
put more money in just to stay steady, that's actually an increase to the purchase price. And
Right.
I'm
Hmm.
going to tell you, the buyer
Right.
later is going to call that unfair. And in his shoes, I get it.
Yeah.
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 Then,
I mean,
we kind of got one time.
yeah, and like a lot of conversations we've had, like this is the first time we've actually really focused on net working capital. Mostly it's been on EBITDA, valuations based on that. But I mean, from your standpoint, being, more in the CFO seat, is
Mhm.
that like when you're going in to evaluate a business, work with a business owner? I mean, is that one of the first metrics you kind of hone in on to really get to that number so they can really see how much gas is in the tank? I know you said it's
Sure.
kind of left out last sometimes in most situations, but is this like one of your top three financials you look at?
It is. Yeah, for sure. I mean, because look, you by the time that anybody would call us, if we haven't been alongside them for the entirety of the negotiation, et cetera, one of the first things that we're going to do when we sit down and just say, okay, you've made a deal, and now you want us to come in and help you professionally run your finance and accounting stack. Well, okay, what's the cash out this month and what's the cash coming in this month? Let's do a real quick back of the napkin forecast. And okay, how much have I got? Am I going to sell all of my inventory and then need to buy some more immediately? Have I got any on the water coming this way? What are my payroll expenses? I mean, those practical conversations, all of that is working capital. And
Mhm.
so sitting down to really understand what our ins and outs are on debits and credits, on the cash movement in the business, that ought to reveal pretty quickly whether or not we're going to have an oh crap moment where we don't have enough gas in the tank, or we're doing great. And by the
Mhm.
way, you came in and you bought an appropriate amount of net working capital with your multiple of EBITDA valuation that you're paying, and good for you, you financed it all well. P.S. You wisely, buyer, hopefully also went and got a little bit of extra borrowing capacity in
Mhm.
the form of a line of credit and or some credit cards. Hey, break the glass if you have to, but leave yourself a little bit of a check valve just in case interesting things happen. And those interesting things,
Mhm.
by the way, don't have to be negative. There could be
Right.
an unbelievable opportunistic move that you'd like to
Right.
make,
Right.
and for want of any cash, you can't seize it. Well, that's not very fun. So let's overload on our
Yeah.
working capital
Yeah.
if we possibly can so that we leave that
Right.
optionality open.
Yeah,
Mhm.
no, I think those are great points. And just to kind of reiterate a couple of things here, when you're a buyer and you're looking at the business, or when you're a seller and you're thinking about how your buyer is going to look at it, um, you always want to think about, okay, what am I paying for? How is the value calculated? And if your value is calculated based on the business and its performance, I mean, that performance, just as you said, Ben, comes from somewhere. It
Yes.
comes from the aggregate of the assets that the business has. And so if a seller just takes out a whole bunch of assets, then there needs to be some sort of recognition of that in the deal terms and the purchase price. You can't say, hey, the business is worth, 5x EBITDA, and then go, okay, now I'm the seller and I'm going to take out all the cash and I'm going to keep all the accounts receivable. Good luck, buyer. I
Yeah.
mean,
Well,
I mean,
you could
uh,
say that,
right,
but is the buyer going to have a lot of fun if they had a different perspective on it? And so that's
right,
where I would
right.
say, yeah, anybody can pay any a free country.
Sure.
We're all consenting
Right,
adults, right?
right.
But you do want to have that moment, to your good point, Sam,
Yeah,
in the LOI,
right,
ideally, which is
right.
the template for the rest of the transaction. In this case, with an asset purchase, it'll be your
Yep.
APA that follows. Well, in that LOI, I ought to say, hey, by the way, if I'm going to pay you $5 million for this company, that is inclusive of an
Right.
appropriate amount of net working capital,
Yeah,
the number of which we'll define later. But here's what I'm really telling you: $5 million
right.
dollars includes your accounts receivable, your inventory, and
Hmm.
maybe even, depending on where we are in the cycle, a little bit of cash that you got to leave in the company.
Right.
Because, yeah, guess what? I'm not paying you $5 million if I can't continue to operate without putting in any more money than
Hmm.
I already have. Period, new sentence. You could make an offer. One could
Oh
make an
yeah.
offer as a buyer and say, hey, I think that the net working capital amount is $500,000. I'm offering 4.5 for the
Hmm.
business, whatever
Yeah.
that means, all the
Right.
other intangible
Yep.
value of the company and then its tangible assets. And then I'm also going to put in $500,000 for working capital, which we agree is the appropriate number.
Hmm.
I can either buy that from you, seller, and we'll call it 5 million, or for me, the buyer, the purchase price is still $5 million. I'm giving you 4.5 and I got to put 500 in the bank day one. And that is a reflection, A, of the cost of the business to me, and therefore what I'm going to use as the
Hmm.
denominator for all my calculation of return of investment. And hey, as the seller, I don't know why you would be mad about getting 4.5 million. There's still a $500,000 of net
Hmm.
working capital in there. Yeah. If it's not inventory and it's just accounts receivable and cash, hey, collect your AR, take your cash. I'll see you later.
Yeah.
Everybody gets
No.
treated fairly.
Absolutely. And I think you nailed it. When it's on the table and that deal term is negotiated at the beginning, it puts the parties in a position to really make good decisions about what those deal terms are and how it all fits together. Because you're absolutely right. You can negotiate whatever you want to and adjust the value accordingly. But if you're looking at the value of the business, and a typical multiple in your industry is 5x of EBITDA, for example, that's probably not 5x of EBITDA, while also extracting a substantial amount of value of the business assets. I mean, maybe it is, but that's where you want to get a good experienced team involved to help you understand, hey, what is customary in the market so that you can set good expectations and
Mhm.
negotiate a good deal. But if that's something that you expect to be able to negotiate, whether you're on the buy side or the sell side, it really needs to be done up front at the beginning with the LOI stage. I mean, I'm a big advocate for. I mean, the more detail you put in that LOI, just like you said, it becomes the template or it becomes the blueprint for the rest of the process. And so, if you've got a good level of detail there, you can have a pretty good process running from there.
Yep.
I like the style of setting some sort of description of how that working capital is going to be calculated, whether it's whether it's going to use GAAP or not, and usually it's not, at least not in the small business
Totally.
segment. Whether it's going to be trailing 6 months or trailing 12 months. I really like the observation that you made earlier, Ben, about looking at the seasonality of the business, because from a buyer's perspective, and especially when you layer in financing and all that other stuff, you're not just looking at, what is a fair price to pay, but you've also got the practicalities. You got to go run the thing. And if
Yes.
you're buying, if you're, a highly seasonal business and you're, excuse me, and you're working capital varies by 2x throughout the year, and you're closing on an average, and it's getting into busy season where you're going to utilize a lot of that networking capital. I mean, you could be, pretty short-handed for a while. And so you really want to make sure that you know what that is. And sometimes it may make more sense to set that peg based off of a seasonally adjusted number, as opposed to we're just going to look at an average. And that might affect price some. But you got
Exactly
to
right.
make sure that you've got enough liquid capital to run the business, and that you've factored in not just sort of maintaining the business as it's run, but especially as a buyer, if you're financing, what do you have that's an additional cash outflow that you didn't have before, Ben?
Exactly right. Yeah, debt service.
Yes.
Yeah.
Yeah. Yeah. And so you got to make sure that, just as you described, Ben, that you're doing all the math, as a buyer, and that you've got all that in there.
Exactly
Um,
right.
when you're on the sell side, sometimes you're going to be in a position where you've got seller financing involved.
Hmm.
And so, sorry guys, we're in cold season.
Absolutely.
Figuratively, literally, weatherly, yeah. Um, uh, if you're on the sell side, should you care about, whether or not the buyer's provided for enough working capital?
Yeah. Yeah, most definitely. I mean, I think that there are two things. If you're a seller acting in good faith, you don't want to buy that company back.
Right.
So, and you do want to get paid whatever the financing is, even if it's like a classic SBA funded deal and you're carrying, 10 to 15%, because the SBA will let you do that. God bless, but that money still probably means something. Why not get paid? And so
Right.
working capital will obviously enable the company to sustain the EBITDA, SDE, whatever you want to
Hmm.
call it, the
Hmm.
cash flow that it had before, which in almost every deal that I've ever worked on, people don't buy and then price debt for growth. Debt gets paid for by holding serve.
Hmm.
Earnouts get paid for with
Yep.
growth.
Yep.
And so you need to be sure that your capacity to make those ongoing business as usual payments remains intact. And so, from that sense, don't get misaligned with yourself. Pay me now or pay me later. If you want to be too uh, greedy at the front end and try to extract working capital, well, that might cannibalize the whole business. And P.S., people are a little bit legacy sensitive, uh,
Right.
even when there's
Yeah.
money involved. So, if you don't want to watch the business go down in flames, just, spare a thought for not only the seller financing that you are due and would like to receive with interest, by the way, um, but also, how will this company be remembered on an ongoing basis? Are you going to try to pinch it too much
Hmm.
and ask somebody to thread the needle in the first 18 months after they buy? That's the most sensitive period of the company. They're learning the
Hmm.
ropes. Things are going to be weird. They're going to have all these ideas. Everybody's going to have to recalibrate after the departure of whoever's been the leader for however long, often decades. So in that variable period, don't short arm working capital. If there's one thing
Right.
that I hope everybody hears, let those
Yeah.
arms grow long, man. Give yourself a lot of play.
Yeah,
Yeah.
I'm sitting here reflecting on my experience when we bought our business in January of 2020. You know, we built out the forecast to have the working capital to cover our debt service, and then COVID happened shortly thereafter, and then
I
and we didn't
might
have a
throw up. Yeah, you
well, we
just
didn't have a
bought a
lot of
business in
seasonality.
January of 20.
Well, and it was a business that had only been around for 4 or 5 years. It was Orange Theory that we purchased, and so we didn't
Mm,
have a lot of seasonality. It was in a growth phase. I mean, Orange Theory was blowing up at that time, doing really, really well. COVID hit. We had a good rise right outside of COVID, and then we had another downturn with this last economic downturn in 23, 24. And it's like, man, it's like I did not forecast for that,
mm.
and so that's where we're in this place of like, and maybe my question is when you're looking at businesses, outside of networking capital, what other financial metrics should a small business owner be paying attention to? Say they don't have a lot of seasonality to go off of in a business. Maybe it's only been around a handful of years and they're gauging some stuff. I mean, is there any other metrics you like to focus on?
Well, I think that one of the things that you want to be very clear on the distinction between fixed costs and variable costs.
Hmm.
So understand what those are right out of the gate. Your rent, famously, rent is the most obvious number that is not going to change, right? And
Hmm.
especially when you're a facility-based business with
Yep.
this expected footprint, brand standards you've got to
Hmm.
uphold, et cetera.
Yep.
I assume as a franchise.
Yep.
So I think that uh, you got to cover that nut no matter what. Debt
Hmm.
service and taxes are right there. People can forget about taxes, but
Hmm.
you are going to pay them. And guess what? You want to pay a lot of taxes. You just want to don't pay any more taxes than you have
Yeah.
to,
Well, when
right?
you're
So
paying taxes, it means that you're profitable. I mean, it means you're making money. I mean, that's
Yeah.
exactly right.
that's the thing for it. So,
Exactly right.
yeah.
So I
Yeah.
think that distinction is important, and a variable cost, and I don't want to be too clinical about this, but at some points, personnel like trainers, for example, could be considered a variable cost. So a lot of
Hmm.
times they don't get paid if they don't show up and the class isn't full, et cetera.
Yep.
Sometimes that's where a lot of your margin capture can be. Well, you can make certain adjustments and accommodations there.
Yep.
So I think that in most companies, people, man hours is either the biggest or it's always in the top three costs. Um, and then depending on the nature of what you do, if you're a distributor, well, you're going to be paying a lot for inventory. It just is what it is. Uh, and there's not a whole lot you can do about that. You're really living off of your gross profit. So what are the levers within your uh, that are within your control that you could pull. I would say that networking capital is a calculation of a large number with a lot of factors in it,
Hmm.
where I would always where we want to challenge people a lot of times just to think a little bit differently and say also like, by the way, this is the jungle. You got to wake up faster than the lion, or else. Maybe you were paying your payables the day they came in and you received the invoice. Could you get terms? Is there a time value to your money that you're uh, not taking advantage of? Is there an opportunity for your receivables to be collected faster? We want to look at the days outstanding on payables and receivables because the cadence of cash and its inflow and outflow is just like breathing. You want to
Hmm.
know how much that's happening. So I think watching the timing there. And then I think that in terms of any other metric, what is a cost to grow that does not require a capital expenditure that is also a significant outlay of cash? What could you do differently to either save money, although saving is kind of easy because it feels like you can control it, but really, what could you go after that is going to get you some growth and do that relatively quickly to generate, any kind of cash at all?
Hmm.
Sometimes that means, hey, you sell that sacred cow weight machine that looks really cool and nobody uses.
Yeah.
I'm
Yeah.
making up an example.
Yeah.
Um,
Yeah.
but that might be it.
Jake and Sam here.
Thank you for joining us. If you find this content helpful, please like, subscribe, share it with a friend, and especially leave us a 5-star review on Spotify or iTunes. It really helps us out a lot.
Yeah. 1 star. It's on Sam.
Yeah, it's definitely on me.
I'm sure that there are two, three people off camera that are shouting that I've completely forgotten and am overlooking a really obvious metric. Um, I would just say that different businesses in different seasons um, are going to need different views.
Hmm.
And
Yeah.
so you just want to be a little bit,
Yeah.
give yourself the permission, in fact, a mandate. Look at the situation you're in right now. Don't think about 6 months. Don't think about, future or past. Today, what are we going to do? That's just critical as a business owner.
Hmm.
Yeah. And I think when you look at the acquisition process or looking at preparing for the sale process, whatever metrics you're looking at, you really want to start with a great team that has the expertise to really help you understand what are the right numbers to even be looking at. Because every business is going to be different, and you're always asking sort of that fundamental underlying question of how does this business create value?
Hmm.
And if I'm the seller, how do I make that value as appealing as possible to, perhaps as many people as possible, or as valuable as possible to the right number of people, so that I can maximize the value of my business? Or if you're the buyer, you really want to understand, where that value comes from and how you understand it, so that you can pay the right amount for the business. And more importantly, you can be set up for success after the deal.
Yes.
Because at the end of the day, we talked about this a little bit earlier on one of our other episodes, um, and this is sort of a realization that a lot of people have had much farther in advance than I have. As a business owner, whether you're a seller or whether you're a buyer, you're not really going to make your money on the deal itself. I mean, you can destroy value on the deal for
Mhm.
sure, but if you're the seller, you really create maximum value through how you run the business and get it to the deal table.
Yes.
The deal table is just where you convert that value into something else. And if you're the buyer, you're not really making your money on the deal itself, although you could set yourself up for success or failure at the table. You're really making your money, or you're really creating your value based on how you run the business after you buy it. And if you know how the business works, and you know the metrics, and you know how it creates value, then you're going to be well positioned as a buyer to be able to go and create the value that you want it to have. But you
Yes.
can't just go in with like, oh, well, this is how all the businesses work, and I just need this because that's what my buddy did on their deal. I mean, that might
Right.
work. It's better than nothing, but it's much better to be in a position where you've talked to somebody like Ben, who's, seen a couple hundred deals, who can go in and be like, hey, let's look at this business. Let's look at its history. Let's look at its client portfolio, and let's figure out how to pull all these things together. But okay, end
Yeah.
of monologue.
No. I agree with you, and look, it's not just self-serving. I know we're all barbers offering haircuts here, but I think that the thing that
What hair?
is right. But I think the thing that is just important for anyone to keep in mind when they're approaching an acquisition is one set of lenses is probably not enough. There's too many
Hmm.
moving parts. There's too many different things, and my even maybe especially for me, because now I kind of get into these rooms and I start to think to myself, okay, well I've seen this movie before, Checkmate in five. Let's
Hmm.
just wire the money. Like, no, you still need to go through every single piece
Hmm.
to inspect how are these joints really connected to each other? How much play is there?
Yeah.
Have we really inspected it? There's a discipline
Yeah.
to getting a deal done that really deserves a lot of respect. And to your good point, Sam, the value of an asset uh, is demonstrated and quantified at a
Hmm.
deal table.
Right.
But everything that has actually led to that realization of value has been taking place for probably 3 to 5 years. Because guess what? That's the look back period for all equity and debt investors. And
Hmm.
so all those capital partners that want to know what's your capacity to repay, they look at that kind of a history. It's not just
Hmm.
the trailing
Right.
12 months, it's how much
Right.
is the trailing 12 a blip
Yeah.
and how much is it consistent with the rest of the trend.
Right.
Hmm.
Um,
Right.
so all of those realizations are informed by history.
Yeah.
Yeah.
Well, and Ben, you said you've done, between 100 and 200 transactions. So you've been in a lot of rooms and, the questions probably differ, but what are some of the top questions that you ask business owners when you're in that room with them for the first time, just to try to get a better understanding of, how they see their numbers, how they, view financials or their business or something like that. Because, a lot of people, you say networking capital and they just glazed over look like I have no idea what you're talking about. Like
Right.
what kind of those questions that kind of start uncovering the things you need to learn about a business.
Gosh, I love that question because we do all need to begin from a place of humility on both sides of that table. If I'm in the room with somebody that's got something worth selling, it's because they're really good at that widget.
Hmm.
And whatever that widget is, I can promise you they did not go into business making that widget to be good at the accounting about that widget.
Yeah.
So the question around numbers and visibility, it's look, are you seeing them at all? And then if you see them, and God willing, it's at least once a month that you sit down and you really shut the door and are over a desk and are looking at these with total focus to understand what are the numbers telling you? What's the dashboard of your company
Hmm.
and the car that you're driving to continue that metaphor? I think that the question that I will try to an overarching question that's sort of an umbrella principle almost is what is your accounting vocabulary and what is your familiarity with deal terminology? As you guys have experienced and as we're already walking through today, doing mergers and acquisitions already is just completely fraught with jargon and all these
Hmm.
specialized
Hmm.
I'm smarter than you terms, which is something I'm guilty of throwing around 10-cent words all the time anyway, because I'm a hopeless word nerd. But I think that the difficulty for a lot of people who are really good at running their company, but have zero interest in a measuring contest around whose financing acumen is better. The operator just wants to talk about the flow of normal business and why the company can make money being good at the widgets. And then you got the pencil neck glasses wearing guy like me sitting over there saying, yeah, but how can I convince a bank that what you're doing is what they need to see? So the
Hmm.
questions that we'll walk through are usually when you're talking about sales and revenue, basic stuff. Do we actually mean the same thing? And then what are your terms? When we talk about gross profit and gross margin, profit's absolute dollars. Margin is a percentage. Are we still together? Great. Now we're going to start talking about your sales costs, your overhead costs, everything below the line. Tracking with me below the lines between net income and your gross profit.
Hmm.
That sort of stuff. We just walk through financial statements. Some people are like, yeah, no, I know all of that and I've demonstrated it in the first two sentences since you walked in the room, so I don't have to go there. Other people, though, were going to work differently. And the most remarkable people in the world are contractors. There is no business that I have yet found that has, aside from medical, and I put medical aside because anybody that's a healthcare provider isn't really in business. You got a different set of physics over there, okay? But
Yeah.
what I'm
Fair. Yeah.
thinking about in a contractor is, anybody with a truck, a hammer, and some good boots can be a contractor, and many of them should be, and they're phenomenal at it. You have got complexity in timing on percentage of completion projects that is unbelievably difficult to keep track of and very sophisticated. And we're taking some people who have not only the least vocabulary, but the least interest in learning how to say it the White Tower way and are out there killing it every day as contractors. And when you sit with them for a few minutes, you're like, man, this is a really dangerously smart person who has absolutely no capacity to talk to a banker. And yet they somehow got bonding and they somehow talked somebody into giving them some debt. And God bless them, this is a heck of a company. I'm going to try to overlay all of the complexity of the stuff that they have to deal with on a daily basis, retainage, bonding, billings in excess of earnings, billings in excess of completion, et cetera. All of those things that you just can trip you up easily. Those guys are playing 4D chess a lot of the time and may not even realize they're doing it. Those are really interesting rooms to get into uh,
Hmm.
because you may not know if you're profitable for 18 months.
Hmm.
That's
Yeah.
intense.
Hmm.
So you want to be attentive on the way in and consistently check and just ask them,
Right.
okay, please, can we look at this number again? Because it's been 90 days. Uh, Woof.
Well, and you observed something there, Ben, of, you may not know for 18 months. I mean, every business you've got to look at it, even within industry where there's generalized standards of how long is that operating cycle? How long is that lead time? And even beyond just the results driven metrics like, net working capital or, your income numbers, EBITDA, whatever that might be, those numbers are a result of something else.
Yes.
And so when you're buying a business or when you're selling it, you always want to understand, okay, where did those numbers come from? What activity generated those numbers? Because especially like if you're in a business where it's a really long cycle, I mean, that's a ship that takes a long time to turn. And if you get in there and you find out, oh crap, the pipeline's empty, I mean, you're in trouble.
That's exactly right.
And there's a lot of folks that decide to sell and they decide to sell before they enter the process, but they start modifying their behavior before the process.
Mm-hmm.
And so they're starting to, see this a lot in small businesses, less so in lower middle market, but it still happens there where you've got a principal or you've got a, key person who's just starting to check out a little bit.
Yep.
And so they're not going out there hustling the new sales, hustling new leads. They're not out there renewing contracts. They're not out there, doing the transition of value stuff like, hey, here's your new contact. It's Bob. By the way, I'm going to go get an office across town where I'm going to occasionally peek in on things, but I'm not in the day to day anymore. I'm handing that off to somebody else.
Yep.
And if you've got a long cycle on the business, that's not going to show up for a while.
That's right.
And so if you're buying based on results, you still need to ask the question of, hey, where'd those results come from? And how do I make sure that they're likely to continue? Because if they're not, I need to know that and I need to take that into consideration at the deal table.
Yeah.
And if you're a seller and you want to get top dollar, you need to be able to paint that picture for your buyer of, hey, I've got a great situation for you. Here's where it is. No surprises. Everything's in good order. You're going to love running this. It's a great opportunity. Here it is. Here's my lead list. Here's all my prospects. You're going to love
100%.
them. It's the best ever. Everybody says so. Yeah.
That's exactly right.
I think it
That's
goes back to
exactly
your
right.
conversation on like, the terms that you've negotiated, the contracts that you have, and like being able to know those are solid. I mean, and those have, tangible value that may not produce for a while, but they're tangible to say like, oh yeah, we just signed a 10-year contract with Boeing for an example, and here's the contract. Now the valuation of your company just went up because you have 9 years left on that contract or what have you. Or if it's coming due where the contract's about to be expired, okay, well, where's that relationship at? Have you been having the conversation with them on extending it, renewing it, whatever? And so, I mean, there's so much that goes into it. They're just beyond the numbers and a lot of what's in the contract. I mean, so much so.
That's right. And the good news here is that, we can say that there's a lot of variability all the time, but like, look, fundamentally, we're still just going to be talking about inventory, receivables, and
Mm-hmm.
then, what did I have to pay and when's my next utility bill due? I mean, these things, they're tedious, is
Mm-hmm.
really the problem.
Right.
Calculating net working capital is tedious. And then truing it up afterwards, it's tedious. Nobody loves
Yeah.
doing that, but it's got to be done and you want it done well.
Yeah.
If it's so tedious that it makes you want to throw yourself out a window, you can buy that service.
Mm-hmm.
We sell it, other people sell it.
Yeah.
So I think also for the
Yeah.
listeners out there, don't think you've got to shoulder the burden alone.
Well, and that's something too, like going back to like, I mean, I think the whole thesis and the whole premise of like our podcast is we have a lot of awesome, intelligent people like yourself on this thing. And it's like, you need to surround yourself with these people because again, you got into business because you're good at making the widget. You're
Right.
not, I am a good accountant, so I think I'm going to go make this widget.
Right.
It's like, no, you learned that you did this or you are in a family business that's really good at something. And it's like, and this is what we've talked a lot about with some of the other folks is like know your strengths. My strength is not in accounting or bookkeeping. That's why I hire great people to be my accountant and bookkeeper on what I do. I know how to sit down and close the door, analyze the numbers, and kind of know what I can levers I can pull. But
Hmm.
in the end, it's like I'm good. My wife is a good trainer on the fitness side. I'm good at sales and marketing. So that's what we're going to focus on. I'm going to surround myself with a great attorney like Sam, the accountant that works with a lot of Orange Theories, for an example, and I think it's just so many business owners, I think they get so caught in just working in their business so without looking up and working on their business of surrounding themselves with great people.
Well, I think just to add to that point, and I would bet that you've seen this a lot as well, Ben, is there's a lot of folks that get and I mean, some of the biggest mistakes, or I should say, the biggest learnings that I've had as a business owner is when I was trading my high value time for low value results. and going out there and trying to do my own bookkeeping because I'm smart enough, and there's all of this software and other things available to help with it. Instead of like pulling my head up out of the dirt or somewhere else and going and looking at it and being like, hey, the best return on my time is not figuring out how to take time that I should be going out and generating a couple $100 an hour for, and turning it into something that I could pay somebody to do in half the time at twice the
Yeah,
quality,
preach.
um,
Exactly. Exactly.
for
Yep.
50, 60, 70, $100, $120 an hour, whatever it is. But I was making that trade all day long, and some of that was, I just lacked confidence in the value of my own time and capabilities. And that's
Mm,
something that takes a while to get used to as a business owner. Is you've got to believe enough in what you're doing, and your ability to go out there and sell it to the marketplace and make that bet on yourself that, hey, my highest and best use is not doing the things that I can pay somebody else to do. Right? It's figuring
totally.
out what are things that only I can do, that I can do really, really well, and how do I spend as much of my time doing that as possible and as little of my time on anything else. Um, and
Yes.
and getting to that spot, I think it's tough. I mean, it takes a while because you got to figure out what that thing is, and then you got to have the confidence to go do it, and you got to have the realities around you. I've got to have enough cash flow to make it work. I got to stick with it long enough to make it work, and all that other stuff. But
Totally.
um, I got one other question for you, Ben. Um, and you mentioned the true up process earlier, and so kind of tying a couple concepts together for our listeners. When you're working on networking capital, it's important from an operational perspective. It's important from a financing perspective. It's important from a deal price perspective to make sure that it's properly understood, properly negotiated. And a lot of times, what that'll look like in the LOI or in the term sheet is that you'll have a networking capital peg, which is that number that says, hey, current assets minus current liabilities, we're going to calculate it in this way. And that's how it's going to be set.
Hmm.
And then there's going to be a true up process, right? Because we're
Yes.
never going to get it exactly right.
Yes.
Um, we're going to say, hey, this is the value that the parties have negotiated for is going to be included. And then we're going to figure out what it really is. And so tell us more about what does that true up process typically look like and why is it important?
Yeah. So usually within the this is such a good question, and this is very hard to trust for people, especially when you haven't been through this before. But the true up, it relates to the as you said, the working capital peg, and within the working capital peg, the net working capital peg, you're going to expect that there will be certain amounts of assets, and you're going to describe what those are, and then you'll have certain amounts of liabilities. You'll describe what those are. So the assets, one of the big ones is accounts receivable. So Sam, I came in to put a roof on your house. You didn't write me a check for cash there. I gave you 30 days to pay me. Well, I'm taking the $10,000 that you owe me. I've booked that as an account receivable, and you're supposed to pay. Well, 90 days go by and you haven't paid. What happens?
Mm-hmm.
We write off the AR. We have to number one have a rule for what we're going to do. Number two, we have to have some time limiter for because no working capital has an infinite horizon. So within 90 days, if I haven't collected the amount of AR that I bought, and that comes with the deal, and or if payables are greater because you were loading up and extending things, and it turns out I owe my vendors more money. Well, the true up process just says, hey, for any extra payables that I had to pay or AR that I didn't receive or inventory that wasn't there, as it turns out, once we really finished the physical count, hey, if I was I had to pay $1,000 extra over here, but it turns out actually there was $5,000 because this could go either way. I could
Mm-hmm.
have AR that I previously thought was uncollectible come in. I could have extra inventory, whatever. After some period, and it's usually 90 days after closing, we pull out the peg, we calculate everything that has happened across those 90 days, see whether we're high or low against either side, assets or liabilities, and then we take the delta. And usually, if it's within, X percent, 5, 10%, hey, whatever, no big deal. if it's sometimes though, you can say, hey, it's a dollar for dollar adjustment. Anything above or below the peg net,
Hmm.
actually either you got to write me a check or I got to write you a check.
Right.
And that's fair.
Right.
And the calculation of the working capital peg always gets done by the buyer because now they're owning and operating, they're
Hmm.
managing all the stuff, and they have to show their work to the seller and give the seller the chance to contest and say, okay, well, no, actually, a check came to me. I just hadn't gotten it to you yet. I don't owe you money. I'm going to give you this check. By the way, when I do, now you owe me money. That whole uh, exchange is important. And so it may take you 120, 150 days to get your working capital peg and true up calculations fully resolved and paid for. It's not just a day of closing end. And in most cases, um, the true up is probably more applicable to bigger deals with bigger dollars and more complexity.
Hmm.
Smaller deals won't tend to have that. I don't
Sure.
know, for example, Jacob, if it would surprise me a little bit if at Orange Theory there was any, when you
No,
acquired the franchise, any
no.
substantial numbers. So this doesn't always apply to all deals, but it's really important when there's a timing cycle, and particularly where there's
Yeah,
substantial balances of AR and
yeah.
AP perpetually carried on the balance
No,
sheet.
we our revenue is received daily, so that's great.
Yeah, yeah. Perfect.
Yeah. Yeah. I
Um,
mean, one of the things that, I mean, we've started talking to folks on, even on smaller deals, is making sure that that's something that at least is considered. Because even on smaller deals, you can have, swings of 50, 60, 70, 100 grand.
Hmm.
Just with,
yes.
how aggressively did the seller, collect AR on their way out the door? How much
Exactly.
cash did
Yeah.
they start to kind of pull out?
Yep.
And you'll typically have reps and warranties. Let's say, hey, everything's been run in the ordinary course and all that other stuff. But usually what that does is it tees up a fight instead of, saying, putting yourself in a position to have a process and a more bright line type of approach, like, hey, what we've agreed to is that the value I'm going to receive as the buyer is a certain level of networking capital.
Yep.
And that creates clarity and it provides process, which tends to leave people in better results. What I've started thinking about, and it's, probably something other people have been at this conclusion for a long time, but is I'd rather make people a little bit more uncomfortable, and help them have a little bit harder conversations and fight a little bit more before the deal's done and figure out how to resolve it while it's easy and while the cost is cheap, rather than say, hey, I really hope this doesn't become a problem later on.
100%.
um, uh,
Especially when in smaller deals, as you were
yeah,
just saying, 50 or $70,000. That doesn't sound
right,
like a lot of margin in a $10 million deal, but that might be all the oxygen you get
right,
in a
Hmm.
smaller deal.
right.
Yep.
Yeah,
So take it
absolutely.
seriously.
Yep.
Right. And if you're in a cyclical business, I mean, that can be a huge deal. That can be
Yes.
a huge deal. And that can be, that can mean as a buyer maxing out your line of credit with your banker or going and applying for one. I want to echo something you mentioned earlier, Ben, of making sure that you've got enough liquidity and you've got enough runway and you've got a backup plan for more capital. And it's not always for the bad things, as you said. Sometimes it's like a great opportunity is going to present itself. But especially if you're on the buy side, you want to make sure if you have the option, that you have access to more capital than you think you're going to need, because something's always going to surprise you. There's always going to be
Exactly.
something new that you learn, and sometimes it's a good surprise, and sometimes it's not. But you want a little sleep at night insurance.
That's right.
um, and it's always going to be harder to go get that later on if you didn't have it ready at the closing, because usually that line of credit's going to be secured unless you've got a really powerful balance sheet or the business does,
Yep.
or it's a really small amount. It's going to be secured. And good luck going and getting options on that, if you've already fully collateralized with your primary lender on the purchase price.
Hmm.
Like a lot of your optionality is going to be gone. Um,
100%. That's
uh,
exactly right.
a couple other quick notes because I know we've got to wrap up here, but another reason a working capital peg can be really valuable for both parties, is it's a good way to help balance out value, when the value of the business is changing through the deal process.
Mm.
We work with businesses where, the business is in a growth cycle or the business is in a contraction cycle. And a lot of times that's going to show up in net working capital. Because if you're selling less, your AR is going to be less. Or if
Yep.
you're in a dramatic growth cycle, you may have a crap ton of AR that's sitting
That's right.
there that as the seller, you can't take out because it's sitting there in AR.
Exactly right.
And so
Yeah.
having that as a part of the deal terms can be a good way, among other ways, to help make sure that the change in value during the deal process is. Did we lose Ben? Oh,
No, I'm here. I'm here.
okay.
Sorry.
That's okay. Can you edit? You make a note to edit that out. Okay. So having those, having that as part of a deal term can be a good way to help adjust for value changes during the process. The other thing I'll note is just from a technical perspective is making sure that whatever that true up process is that it's done timely, whether that's 60 days, whether that's 90 days, but then also that there's a reasonable amount of time to pay whatever that true up is.
Hmm.
If you're the buyer and you owe the true up to the seller, there's a really good chance that that is a result of a growth in AR. And if it's a growth in AR, you don't necessarily have the liquid cash because you can't pay your seller in AR. You can
Exactly.
only pay your seller in cash. And so
Exactly.
you may need to make sure that you've got a little bit of time, whether that's 30 days, 60 days, or whatever, after the true up is completed to make sure that you've got enough liquidity to pay that amount. So then before we sign off here, what are your kind of best tips for folks that are thinking about maximizing the value of their business as they just kind of generally as they get ready for that process on the sell side?
Anybody that's preparing for sell side, I would just say every single deal that I've ever done, every single deal that I've ever looked at, number one on the diligence request list is financial statements. Know them, have them, be ready to stand with them, get prepared. So please, please, please make your life easier. And frankly, that may be the difference between getting a deal done at all or not. Uh, you need to have financial statements that actually are representative of what's going on in your business. So if you do that, it's going to make everything else hang together, and a buyer will be able to triangulate between what you're saying about operations and what's showing up because
Hmm.
financials are a lagging indicator.
Yeah, no, that's great advice. That's great advice. If a buyer can't trust your numbers, how are they supposed to trust the rest of the things that you're telling them?
Right,
So,
exactly. And
yeah.
frankly, as I was saying a lot of times when I was on the buy side, I would tell sellers, hey, you don't got to convince me. I got to convince a bank.
Yeah.
Yeah.
I'm ready to
Yeah.
believe you, but I
Yeah.
want their money.
Right.
Yeah.
So how are we
Right.
going to do that?
Yeah, for
Yeah,
sure.
yeah. No, we tell our buyer clients that sometimes of, hey, it's good to have the bank there as a as a foil if you need them. Be like, I can't sell this to the bank. All
Yeah.
right, you got to give me something better than
Like you
that.
would say, happy buyer, happy wire.
Yeah, yeah. Happy buyer, happy wire.
Oh man,
I've got a couple of clients with that on a bell.
I love that.
Yeah.
That's awesome.
Awesome. Awesome. Well, hey, Ben, thank you so much for joining us. Thanks for sharing your wisdom and your experience with our clients. We're here because we genuinely believe that so many did I say our clients? You're here with our clients. Some of our
Our
audience members
listeners.
are our clients. Good Lord, I need more sleep. I got little kids at home. Can you tell? Um, but with our listeners, is because we know how important these moments are, these transitions. You know, whether it's to a family member or whether it's buying or selling a business. And for a lot of folks, it's going to happen once, and we want it to happen really, really well. And thank you for investing in the opportunities that our listeners have to make a difference in their families, their teams, and their communities. We appreciate you, Ben, and thank you for taking time to join us.
Thanks,
Hey,
Ben.
it's been a pleasure.
Yeah.
Thank you guys.
Yeah.
Yep.
Take care.
Yep. And listeners, tune in next time for more great thoughts with Sam and Jake. All right. Bye.
Thank you for joining us today. For future episodes, please subscribe to the podcast on Apple Podcasts or Spotify. And please check out our website at www.goforemanlaw.com/learning.